we've got ourselves a great panel and ready to talk about the trends and the future of the battery metals. The reason why we're having this panel today, this special panel, is because we've received lots of inquiries and interest for us to cover the metals market directly beneficial to the rise of the EVs, namely some of these metals, lithium, graphite, copper, cobalt, nickel, etc. So I would like to first give a brief description about the three panelists first before we start off with our discussion. So the first, the CEO of Camino Corp, Chmelauskas, who presented the story earlier today. And he has quite a resume on running various mining companies that end up successfully being sold to bigger companies, including Jinshan Goldmines and Western Lithium. The second panelist here with us today, he's the managing director of House Mountain Partners, Chris Berry. Chris provides advisory and consultancy services to a broad array of clientele, including asset managers, corporations, academia, and on how supply chain dynamics are being altered by the volatility in commodity markets, geopolitics, and macroeconomics. And finally, the last panelist, he's the president of the boutique firm Stormcrow Capital from Toronto, Dr. John Hykawy. He has a vast experience in strategic metals, lithium research, and has been quoted by a number of media throughout the past 20 years. So welcome you all, three of you, and to join the panel.
Thanks, Gilbert.
Thank you.
Yes, I'd like to maybe start off by first sort of warm-up question, the very broad and very important question to the state. And we, from the audience, we realized the revolution of the electric vehicles the last decade, the increasing demand from the lithium-ion batteries. So in your mind, which metals do you think will be the critical and the most beneficial to all of this rise and revolution of EVs? I would like to have these, your take on all three of you. Maybe we start off with Jay. Jay, can maybe you start off by giving your take on this question?
Well, thanks, Gilbert, and again, thanks for having me participate in your conference. And it's been very insightful hearing some of the other presenters as well. And nice to see John and Chris, together here through COVID. Look, yeah, I mean, I used to be the CEO of Western Lithium, which is now Lithium Americas, and was looking at lithium and still do as the enabling metal for electrification. So I think lithium is definitely the most important metal because it's irreplaceable. There's no substitute for it today in terms of achieving the energy density that you need for mobile transportation. And I'll let John and Chris talk about some of the other metals. But I'm behind a company now called Camino Corporation, which is a copper company. And while I think lithium is the enabling metal for mobile, transportation, I believe that copper is the enabling metal for the entire electrification of our economy. And I say that because if you think about replacing sort of liquid fuels and gas and solid fuels for that matter, to supply energy to electric cars, you're talking about an electron that has to be generated at a renewable energy source, which would be potentially wind or solar. That's copper intensive. Then it has to be distributed into the market through a copper intensive or copper alloys into the market into some sort of storage, which could be lithium batteries or other means. That's copper intensive as well, and then into the lithium battery and into the electric car with copper wire motors, in some cases magnets. So we're talking about a copper intensive requirement for this electrification of our global economy. And I'll let some of the other speakers talk, but I've got some other concepts that I'd like to talk about on that front.
Yeah, Chris, do you want to agree or disagree or add something to that?
Sure. Yeah, I would not disagree by any means. Lithium, I think, speaks for itself. There's not much that I can add there. What I am really focused on these days is a little bit less, what is the winning metal? Is it lithium? Is it nickel? Is it copper? Is it rare earths? And thinking a lot more about innovation and advancements on the cathode side of the battery in particular. One of the things that I've learned over the last 10 years or so in this business is that substitutability and trade-offs are part of the game, for lack of a better phrase. And so, we can talk about a move, for example, towards nickel-heavy cathodes, which certainly looks like that's where we're going. But, what does that mean for the nickel price? What breaks even? How do we get more class 1 nickel on stream? I mean, these are a lot of challenging questions that I think the industry is just starting to reckon with. And when I say the industry, I'm really talking about the downstream portion of the industries, the OEMs and the automotive manufacturers. So, I think that what I'm encouraged about when I think about vehicle electrification and energy storage is the amount of R&D that's focused on this space right now, and really a lot of innovation, in particular on the cathode side of the business, that I think is coming down the pipe. I certainly like lithium. It is irreplaceable. I think nickel presents probably a pretty interesting opportunity out of the next couple of years, but I really have spent a lot more time in the last even 12 to 18 months thinking about cathode technologies and advancements and how you manage a whole bunch of different factors, increasing energy density, managing costs, and of course safety, which is really the name of the game.
Yeah, maybe John, you may have something to add, because I know you study a lot on how the different innovations are going on in the technology advancement in the battery metal side too. Maybe you can add something more.
I'm afraid I'm not going to disagree with anybody, Gilbert. I think the comments so far have been spot on. In particular, if I were looking at a couple of metals that still concern me, it's probably the obvious ones as far as batteries are concerned. Lithium is irreplaceable in the lithium battery. There isn't an option to replace the actual ion that exchanges energy. Cobalt is actually physically rare, and it turns out it's becoming and viewed as increasingly difficult to switch it completely out of the battery chemistries that we're dealing with. And nickel is not problematic in the sense of absolute supply, but it does become an issue when you start to consider the topic that Chris raised, which is, can we do all of this inexpensively? Because we have to remember that consumer electronics, automotive, all of these areas that are the highest demand sources for lithium batteries, these are not industries that can afford to, they're not money is no object industries. They are required to provide these materials to provide their final product as in the form of batteries or devices or battery electric vehicles at a low price. And so having raw materials that are also low cost will help. If this demand is going to push that supply and demand dynamic out of sync and drive prices much, much higher, it's going to be very difficult for automobile manufacturers and device manufacturers.
Yeah, okay, interesting. So maybe let's, there's a hot topic going on, and maybe we can go in for that. In terms of COVID-19, obviously, it's a big thing going on, the pandemic. And have any of you seen anything that surprised you in terms of how it changes the supply chain in the battery metals market? Maybe Chris, do you want to comment on that, on how the COVID-19 and...
Sure, I think that COVID plus the ongoing trade war between the U.S. and China has really shone a light on vulnerabilities in the supply chain, for lack of a better phrase. I think that at least initially the focus was on PPE, personal protective equipment from a medical perspective, but a lot of what we're hearing these days, and I'm actually in Washington, D.C. as we speak, President Trump has issued an executive order sort of encouraging industry, I think, to re-examine supply chains and re-examine the dependence, for lack of a better phrase, that we in the West have on these strategic and critical minerals. That there is a cynical view that we've heard all this before. I mean, if you just go back to 2011 or 2012, and a lot of the arguments that are being made today around critical vulnerabilities for supply chains were being made in 2012, and not much has happened. I would argue that COVID and also just general cost declines in technology overall, certainly with batteries in terms of dollars, cost in terms of dollars per kilowatt hour, is much lower today than it was in 2012. And so all of a sudden the economics around these supply chains are being rethought, and I think they should be rethought. The idea of decoupling, I think, sounds great in theory, but again, to echo John's point, at the end of the day, economics matters, costs matters. You can have smaller, more regionalized supply chains, whether or not we're talking about medical equipment or strategic materials, but it's going to come at a higher cost and it's going to be less efficient. And I think that, businesses are probably just in sort of the very first inning of reckoning, how far we want to go with respect to decoupling. But there's no question that if the trade war, the trade war between China and the United States put this idea on the map again, COVID has really added fuel to the fire.
Yes. So any of you want to add to that? Anything that you see surprising you on how about the rebound of the market or in general on the metals market, Jay?
I guess I am slightly surprised at the rebound in the copper price. Obviously, we had a lot of production fall off with COVID, and it could happen again as cases come back, whether they come back or not in major producing regions like Peru and Chile. In Peru, production has mostly come back, and I think just on this topic of COVID and strategic, trade wars. I do think that China is possibly restocking right now with copper, with cobalt, with other metals, and so that could have a short-term demand pull, which is supporting prices now, but ultimately stimulus, U.S., Chinese, into investments and primarily it looks like the stimulus is going to these green electrified economic investments, renewable energy, that would have a major driving effect in the medium term on copper prices, and then and basically long term is this whole electrification theme that I was talking about earlier. One other comment, just on pricing and investment. You always need you need incentive pricing, for investments to be made, and with commodities and whether they are strategic, or lithium or more of a longer term commodity that we've seen, with nickel and copper, you get cycles in the industry, over investment and under investment. Depending on an incentive price. And right now, you can say that in most of these commodities, the incentive pricing is not there, to build new mines. And so, and these mines, and interestingly enough, in my analysis, a lot of the capital that goes into these projects, it's pretty similar in terms of the capital intensity, $10,000 to $20,000 per ton of product, whether that's a lithium mine or a nickel mine or a copper mine. And so, interestingly enough, there's about the same amount of copper as there is lithium, in a lithium battery. So that alone, if you think the lithium market is going to be 1 million tons a year, that means the copper market is going to be 1 million tons a year, which, at $10,000 to $20,000 per ton would require about $20 billion, $10 to $20 billion worth of capital from each of those industries. So the question is, you add that up with cobalt, with nickel, with lithium, with copper. These aren't, and you know, you're looking at where is the next $100 billion going to be invested, you know, on these supply chains, and where's the best jurisdiction, you know, to invest this money, where's the lowest cost jurisdiction, you know, so that you can meet these cost targets. So those, you know, that's where I see a lot of the investment decisions being made in the future.
Yeah, there's a good comment on the investment side. Maybe we can go back to that discussion shortly on the investment side. John, I'd like to see your take. Do you think what Chris was mentioning earlier about the executive order? We all know that it's hard. Is it hard, really hard to really just, it's a theory that is difficult to actually get the strategic metals in the proximity of how this whole globalization going on? Is it just a okay thing to do, or is it really people can really move around and get sourcing of the materials easily now?
I think there's a couple of pitfalls there. The first is as Jay mentioned, the incentive pricing on a lot of these commodities to get new mines into production simply is not there. I mean, if I've been shocked by one thing, it's how rapidly some of the lithium stocks, the lithium company stocks, have rebounded in terms of price compared to what the lithium chemicals are doing in price, which is lying there dead at this point. I expect restocking to begin in terms of lithium chemicals in China, but it hasn't started as of this minute. The real incentive is going to be provided by somebody being able to open a new mine and make money. And until the commodity prices get to the point where that's possible, as well as the quality of deposit being there, which may not necessarily be true for a lot of the deposits of these critical materials in, say, the United States, then I don't think it matters how many executive orders are signed, unless those executive orders are backed up by significant money from the US Congress. And there's been no sign that that's going to happen yet, Gilbert.
That's very true. Maybe we could follow up with that investment thesis. So what do you think? You all think what are the best investment opportunities now surrounding the battery metals market? So lithium price has gone down quite a bit last year, and is that for mid long term? Is that lithium companies will be one of the best investment opportunities, or do you have other things in mind? Chris, you want to, because you follow up quite a bit of the space, you get a portfolio of companies. You want to take a look, talk about that?
Yeah, I agree with John in the sense that I think the lithium equities today are way ahead of, you know, market fundamentals. I don't know how that equilibrates. I don't know if we see some huge drawback in lithium share prices, both for the producers and the near-term producers, by the way. It's not just the juniors that I think are stretched. Again, you know, I guess my own personal view is I wouldn't see sort of structurally higher lithium pricing before, say, late 21 or 2022. And that just has to do with, you know, how I'm viewing the market today in terms of what's being produced, what's already out there in the market. I mean, it's no secret that there's an oversupply issue with respect to lithium today that will get worked through. And when it does, you know, you will start to see higher lithium pricing, I am certain. On the, just to sort of talk about some of the other metals, you know, we touched on nickel, for example. When I look at that market and I look at how it's sort of bifurcated in terms of the different sources geographically and geologically, and of course this need for what's known as class 1 nickel primarily, you do need a much higher incentive price, arguably as high as $18,000 to $19,000 per ton. Today, we're at around $14,000 to $14,500 a ton. So, you know, I think that there is a ways to go here in terms of where pricing is today and where it needs to be to bring that supply to market. You know, there is an enormous amount of capital sloshing around in the financial markets these days. You just have to look no further than what's going on with the SPACs, the special purpose acquisition companies here in the United States. Probably the one that is, I think, perhaps the most familiar to this audience is MP Materials, which is planning on going public. I think the deal will close later later this year, of course, that is Moly Corp, which many of us on the call will probably remember from a few years back. But nevertheless, I think, again, at the end of the day, it's all about the economics. We can write reports and we can have presidential proclamations and talk about supply chains. And we can do all the hand wringing. But at the end of the day, when you look at any of these companies, then it doesn't matter to me if it's nickel or copper or cobalt or rare earths. What you really need, I think, as an investor to be able to sleep at night are some pretty fundamental criteria. Okay, obviously large scalable deposits, high grade, reasonable metallurgy, and of course, for me, what's most important is who is running the show. Who's the management team? Have they done this before? Yes or no? And I think if you can get some clarity around some of those fundamental questions and be patient until pricing does ultimately come back, I think, arguably you'll be just fine. I'm obviously not an investment advisor, so this is not advice, but I guess my point is that, we can get as detailed as we want around technology and geology and so on and so forth. But at the end of the day, the fundamentals for, I think, looking at this industry and looking at the opportunities within it are very simple and very straightforward.
Thank you, Chris. I think that's a very good point there. Jay, do you want to add anything to earlier investment thesis for copper?
Look, I can't add much more there. I think Chris summed it up, but I would say, just following what he said, copper is at a cyclical low right now. I mean, we've had a bit of a bounce here in the last few months, but we haven't hit incentive pricing, which would be closer to $6,600 per ton. And so fundamentally, copper has a long way to go. And when I say a long way, I mean, a decade I would say that the copper market could look similar to what we saw from the 2000 to 2011, period, where we saw China, basically supporting the copper market, and that would be replaced by, this whole electrification theme. I think the copper market will, have some fundamental value, upside over the next decade. And if I were to say to one thing, to compare it with lithium or cobalt, it's probably going to be less volatile as those markets.
Yeah, good. Well, John, you've seen so many mining companies and CEOs in your days. What are the common mistakes they went through in terms of running a copper company, lithium company, no matter what company they do? What do you have to advise the people in terms of investment opportunities these days?
You're making me sound really old, Gilbert. But I'm getting old, so that kind of makes sense. I'd say the basic mistake that I've seen many people make is an unwillingness to dilute when the timing is correct. You see too many junior companies coming along, and they decide that they managed to figure out that a cobalt deposit was a decent thing to do, or a lithium deposit was a decent thing to do. Suddenly they're confronted with a market where those prices have gone up, all the equities are appreciating. They turn around and say, I don't want to sell any paper at these valuations. Well, you're not going to advance your project without some dilution. That's a necessary thing. And I make a living out of trying to advise companies how exactly to limit that dilution, how most sensibly to raise the money that they need. But you do have to dilute. It's without question. And if you decide not to sell equity while the market is good, you may well be sitting on a deposit that locks these materials in the ground until the next bull cycle comes along for you, which could be 4 or 5 or 6 or 10 years, who knows? The problem too with a lot of critical materials in particular, less so with bulk materials like copper, but the problem with critical materials is if you have a defined small market for these things and you decide to delay construction because you're waiting for the right valuation, you're waiting for the right offer, the right partner, whatever else, you may well end up with somebody else beating you to market. And with them providing sufficient material to keep the price reasonably low, you may not find any partners or investors that want to enter the space at that point. You may not be able to achieve the sort of incentive pricing that it takes to bring those investors into the fold. It's a difficult dance to do. Your timing has to either be very, very good and very, very lucky, or you need to decide that you're going to raise the capital required. You're going to experience the dilution necessary, and you're going to get it done.
So let me throw you all one last question before I go to the audience and take maybe one question from the audience. The US-China trade war, and who will win at the end? And what's your thoughts on that one? This is trying to make some controversy here. Maybe, how about John? John, do you want to talk first this time?
Oh boy. Save the good one for last, did you? Okay. We published a couple of papers, Gilbert, Stormcrow has, on trade war and on the possibilities as a result. So if anybody wants to find our website and look up those papers, they're welcome to do so. I guess the thoughts that I would have is in engaging in a trade war, you want to cause an asymmetric level of damage to your opponent. You want to try to do something that will result in your opponent losing more as a result of your activity than you're going to lose. In that sense, China is fairly uniquely positioned to do some serious damage if they choose to go down that route. And I'll give you one example that isn't in the papers that we wrote, because we were concentrated solely on a US-China trade war where Chinese authorities were trying to do damage to American interests, and solely American interests, but it's one that's a wider sphere. The material that I would target would be gallium. Gallium is a soft silver metal, doesn't matter to anybody, doesn't make attractive jewelry, nobody cares, except for the fact that it creates, in combination with either arsenic or with nitrogen, some really interesting semiconductors. What those semiconductors do is they allow you to create power amplifiers that work at very high frequency, and they're used in devices like cellular telephone handsets or cellular telephone network base stations. Without gallium, without the power amplifiers that get created from those gallium arsenide and gallium nitride wafers, there are no 4G and 5G handsets. There are no 4G and 5G base stations. We couldn't communicate at any reasonable distance using any alternative. And so the problem we would have globally, if China cuts off gallium, which China is responsible for about 96% of gallium production in the world, and it isn't a whole lot, is that we'd lose, what's the size of the telecommunications industry, the mobile telecommunications industry? Hundreds of billions, trillions at the end of the day when you include economic fallout? That would be a problem. What does China lose? The sale of about $70 million a year worth of gallium metal. Now that's an asymmetric weapon. Now, would they do that and risk making the enemies that they would probably make as a result? I don't know. But I'd rather not push anybody far enough to find out.
Interesting thought. So Chris, how about you? What do you think will end up?
You know, look, there's a lot of talk out there today about whether or not the United States and China have entered a new Cold War. And I think that that is being viewed through the lens of the previous Cold War between the United States and Russia. From my perspective, Russia and China are, for lack of a better phrase, I think Russia is looking for friends, and from a regional perspective, there's some competition there. But generally speaking, aside from the political system of communism, Russia and China really do not share any characteristics that would tell me that the US and China Cold War is anywhere similar to the Cold War that the US and Russia engaged in up until about 1991, until Russia collapsed. So, in terms of who's going to win, I don't necessarily think this is a war per se. It's certainly a race. I think it really involves, to sort of echo John's point, it revolves around technology. It revolves around IP development in particular, which is, again, coming back to the comments that I started off with about, focusing on cathode technologies, anode technologies, things like that. I really think that's important going forward. So, who's going to win? I mean, it is sort of an existential fight between communism and capitalism, and we don't have enough time on this webinar, or even probably today, to talk about what's going on here in the United States with respect to political dysfunction. So I won't go there, but what has started again with the trade war and then has been exacerbated by COVID is not going to stop anytime soon. And this tension between the US and China, I don't see a Biden, a Vice President Biden, perhaps a President Biden, any maybe less antagonistic to China, but certainly I don't see a lot of the tariffs or anything that have been put in place being pulled back anytime soon. So it's a little bit of a stalemate, I think, to everyone's detriment in the next few years.
Sure. Jay, do you want to finalize and maybe talk about how the trade war will be affecting the metals market too?
Well, yeah, just to follow up. Look, I don't think anyone wins in any type of war, a trade war included. The consumer will lose, and even groups that potentially have protected jobs don't necessarily win, because those jobs are in non-competitive, businesses, and so it is. I wholeheartely agree with what Chris was saying there. It's a race of technology, and the way to be competitive is invest in training, technology, people, and you will win that business. And it's economics 101, comparative advantage. So where you have a comparative advantage, that's where that trade should go. I believe that in Peru we have a comparative advantage in terms of the type of deposits that we have, the quality of copper deposits that we have down there, and that's demonstrated by the fact that it's the second largest producer in the world. So that's why Camino Corp has moved our focus to Peru, and that's where we believe a major source of copper will come to support the electrification theme going forward.
So thank you, all of you. I think time really flies, and we actually went a bit over time, but we won't be able to take any of the questions from the audience. It's too bad, but I really enjoyed the conversation with you, all three of you. I wish I have maybe half an hour or even an hour more to talk about other things too. So very great thanks to all three of you joining us here today for the panel. And next, of course, we're gonna see how the U.S. election go from pretty shortly soon, and we'll see how the market reacts. So I will thank you all, and I will see you later. And let me conclude here for the conference. Thank you, Jay, Chris,
Thanks, Gilbert.
John.
Thanks so much.
Thanks everyone.
everybody.
Yeah, great.